All right. I had mentioned before that I wanted to go a little bit further, a little deeper on the levered products. Um, to be honest, I don't think I will exhaust the topic in this video, but I'll get a little bit further into it. And I don't know if I'll do another one because at, at a certain point, I have to admit I don't fully understand exactly how some of these are structured and put together. Even looking into it, most of what I found was on leveraged ETNs, which is slightly different than a leveraged ETF. But I would imagine that they're structured in a at least somewhat similar manner. But one, I guess, can't really be sure. So what I talked about before, these are all products that are made up of. Now, this I took from the definition of ETN. So this is where you're going to have to bear with me a little because it's not going to be direct, but it's very similar. Um, Leverage products, they're usually made up of a bond or one or more derivatives linked to what I refer to as a parent or underlying asset. So, for example, when I say parent, you'll have things like I have over here on my my monitor that's off to my side here, that's vertical. I have SOXL currently and SOXS. So you could replace these with those two funds because these are what I traded today, specifically SOXL. But TQQ and SQQ are the same thing, but they have a different parent. Their parent or underlying asset is QQQ, and the underlying kind of asset for QQQ is /NQ, which is the NASDAQ futures. So I will generally watch them both, as I think I've shown before. Oop, what'd I do there? I have this generally on my top monitor. So I have the futures for both the S&P 500 and the NASDAQ on there, and VIX, and usually a couple other relevant things that kind of vary. But most of those kind of stay the same, at least the bottom couple rows. And then the top right, the VIX, I usually leave as it is. And a couple of them will change here and there. But that's a non-issue here. So you combine shares in an underlying bond, stock, or ETF with a derivative like an option or a swap contract. And this is where it gets into like a little beyond my depth because I'm not really sure how or what it is that the swap contracts exactly are. I know they're structured by investment banks and certain fund providers like ProShares and Direxion. I don't know, but I know how they act. So those are derivatives which offer leverage exposure. Uh, so these are definitely aimed at retail investors simply because a professional would just go execute in the manner that these are structured in without paying the high expense ratios. For example, I mean, like, if you're a professional in the industry, why would you buy a product that somebody has already like structured when you yourself could just go buy the underlying asset and then go buy an options contract to get the same level of exposure that those products offer? Whereas for retail investors, for someone like myself, I've never got into options. I know a lot of people trade them. I don't really mess with them. I want to master, or at least somewhat master, trading stocks before I even worry about getting into a whole nother ball game, you know? And so that being said, someone like myself who doesn't want to know, oh, like how many contracts do I need to get the 3 to whatever ratio of leverage, and should I be getting a call or a put, and you know, what's the strike price? And I'm just throwing out any sort of options nomenclature that I know at this point. But I don't know all that. So all I know is that somebody else knows that, and they have made this product called a leveraged ETF. And I can buy and sell that just like any stock, just like anything else. I type in the ticker I want. Boom, there it is. I go into my order box. If I pull up the Acer again, you can see right here, number 2 is for this top chart. This right side, number 3 right here, if you can see that, is for the bottom chart. And these change. Sometimes I'm trading TQ and SQ. Sometimes, like those change, but the order boxes follow respectively. And I can go right now and buy 100, 300, 500 shares of one of these and, make my bet. So that's what I understand, and that's why I play them. Now, the one downside to the way these function is that you can't use margin on them, which I personally think it makes sense. And at the end of the day, it's a good thing, because if you have day traders margin, which means the first $25,000 in your account, up to that PDT level, you get 4 times margin on that amount. So if you have, for example, $26,000 in your trading account, you would have $102,000 of buying power. That first $25,000 would give you 4x margin, not 4x as in forex trading, but 4x as in 4 times. I should specify that. So on the first 25,000, you would have $100,000 worth of total buying power. And then since I said you have 26,000, that 1,000 over, you would have back to your standard 2 times margin, like you would if you were under PDT. So for every additional $1,000 after $25,000, you have 2 times margin on that capital. Whereas the first 25K, you have 4 times margin. So you could actually get just as good, if not better, returns trading individual stocks, assuming you're picking the right names, or trading ETFs that are marginable, because these leverage products, once again, you can't use margin on. So that's a little bit of a drawdown, so to speak, or a drawback, I should say. However, I don't know. I'm torn on it. I don't think it's that big of an issue because they're already leveraged as it is. So if you're under PDT and you only have 2x margin, you're getting like 3x leverage exposure without having to use any margin, so you're actually gaining a margin multiple on top of what you already had. So back to my notes here before I ramble for too long. So as I already said, they're structured by professionals at investment banks, and they have notably higher expense ratios. So like VOO, the Vanguard S&P 500 fund, has an expense ratio of 0.03. QQQ Investco has a higher expense ratio of 0.2. But most of these leveraged ETFs have an expense ratio over 1%. So you're talking quite a bit more on a percentage basis. You're talking like at least 33% more, if not like 300-400% more. But at the end of the day, that really, like, so far when I've traded these, I had a trade the other day that I made a little over $800 on, and I think my total fees, when I looked at my TraderSync account, which is a thing you can subscribe to like do trading journaling, and you import your portfolio and it tells you all your statistics. I would highly recommend it. But when I looked at my TraderSync, TraderView, same thing. There was $2.33 of total fees from my leverage trades. And it was like, okay, so for every $100 or so I made on it, I'm paying like 10 cents or less of fees. So it's not that big of a deal. But once again, if you were to think of these as a buy and hold product, which you never should, that would be noticeable, especially because these products also do not pay out any dividends ever. Whereas the underlying asset that is their parent, for example, the QQQ or VOO, for example, again, they will pay out dividends, and you can use the DRIP, the dividend reinvestment program, if you so choose. Furthermore, I had also mentioned multiple times that these are rebalanced daily. And there's actually been lawsuits about this because people did not understand what it meant to be rebalanced daily. They thought, oh, well, if the S&P 500 goes up 30% in a given, or 10% in a given year, this should go up 30% because it's triple leveraged. And there were actually class action lawsuits that sued, I can't remember if it was ProShares or if it was Direxion, but they sued them because they were like, hey, this isn't doing what it says it does. And they're like, no, it does. You just didn't understand it because you didn't take the time to read the whole prospectus and the whole outline of how this actually works, because it's rebalanced daily. So that was a little bit on those. I wanted to get to, once again, it tracks an underlying parent, and I don't know if I showed before. So for example, if I bring these, I'm going to change the ones on my other TQQQ, SQQQ. So this is QQQ, the NASDAQ. Once again, this is to some degree dependent on the futures, which is /NQ. And now if I bring up my other monitor over here, so these two tickers right here, TQQQ and SQQQ, are the children or derivatives of this. So when I'm executing on those, I'm actually only ever watching this, typically on a 1 minute chart like this. And then I watch this, and if it's going, let's say it's going up like today, I would buy TQQQ because it trades directly. If it's going down, I would buy SQQQ. So yeah, that's the parent-child relationship. And for the ones I had up there before, SOXL and SOXS, their parent is SOXX. And I do the same thing. I'd put SOXX on here, and I'd watch it trade, and I would execute on the triple leveraged products, even though I'm watching the parent. So that being said, I'll go back over here. I pulled up, there's actually more of these than I even realized. I didn't realize how many of these triple leveraged products there were. So, well, I guess this is triple and double. So you can see here, we're on Direxion's website, which is one of the companies, financial companies that structures and provides these products. And they lay out here the tickers for all of their different, didn't mean to click on any of that. For all their different leveraged funds or geared funds, sometimes you'll see them referred to as. And these go pretty in depth, pretty like narrowed down to a fine niche, like fine sectors. So you can see here what they track and what their parent is, in essence anyways. Actually, I don't know if that is their direct parent or if that's just an accurate acronym for this. I'd have to look more into that. What did I just do? Let's see what happens here. Oh, it's the prospectus. Okay. So that would actually probably tell me what its parent is. But yeah, there's all sorts of these. So these are the double leveraged here. As you can see, 200%, 200%. Ooh, this one's probably not looking good right now with the Russia stuff going on. But yeah, there's a ton of these. So here's 3, 300 or triple leveraged. There's a ton of them. Here's the ones I was just talking about for the semiconductors. And the thing I like about trading these is because I've noticed for myself, it really annoys me if I'm in a laggard and I don't have as much confidence or conviction when I'm trading individual names, generally speaking. But I tend to be pretty good at understanding like the underlying like macro effects of what's going on with, you know, rate hikes and Russia and this and that, and how that's going to drive the direction of the overall market or the overall sector. So I have a lot more confidence and conviction in trading an entire sector or one of the products based on one of the major ETFs in the market, like SPY or QQQ or the Dow Jones, you know. So that really plays into effect because trading is so highly psychological. And if you don't have true conviction or a real understanding of what you're trading and is this a good play, then it can really mess with the trade and make it so you don't trust the trade and therefore don't let it play out as it should. So for me, I know it might be hard to see. I think I have my other camera here. For me, when I said I trade SOXL, now I have SOXX here. And if I go to, I guess I don't have it on this one. Anyways, I have looked up multiple times what holdings are in SOXX. So what names, what specific companies are put into a basket and sold as SOXX, the ETF. And those companies are all over here on this top monitor. Now, I shouldn't say all. This is the top, 12 of them. So the top 12 weighted names within SOXX are right here. And that gives me that added layer of conviction that I like, because as I'm watching this, if I say, okay, this is looking like it's, looking like it might be a good entry point right in here, close to the VWAP, I will look up over here and start to really see, okay, how are all these names opening? How's Broadcom? How's Qualcomm? How's Nvidia, Intel, AMD? Like all these names, Micron, AMAT. How are they looking? And if I can see kind of a confluence of these entrance indicators lining up, as in all these look like they kind of dipped a little out of the open and now they're all starting to turn and drive. And right as they're starting to turn, and this is SOXX ETF is looking good because, of course, it's just tracking what they're doing. Then I will execute on the leveraged product. So that's how I play them. And I really like it simply because they offer a lot of ways for me to have different things that add to my conviction in a given position, because that's something I kind of suffer from, is that I don't tend to trust the trade setup, and it will be, within my risk parameters, and I'll see one volume tick or one sizable order, whatever, that makes me feel uncomfortable, and I'll get out, and then the trade will end up working. I did it the other day on SQQQ. I entered and it was still within my risk parameters, and had I held on to that trade, it would have been an excellent trade. It was actually, I still have it plotted. So let's look at that one. Oh, why does it always put more? It always adds more characters. So I entered, as you can see, right here, this blue line is my entry. That's just like a habit of mine. Every time I enter a position, I post a blue line, and then, like, let's say I add to my position and bring my cost average down, I will right click it and move the line to where my cost average then is, but I'm going to leave it where it's at because that's where my cost average was. Well, this I expected it to move more violently. And like I said, normally I have good conviction on these, and I did feel somewhat good about it. But a couple days before this, I had 2 days in a row with really nice, healthy gains. So this day, I was a little bit uneasy because I didn't want to end up giving some of my profits back. So when this was red, I was in the red maybe $100. I think it wasn't even quite $100 because I had only added in maybe a half or 2/3 of my intended size, and I just jumped out of the trade. Well, if I would have held it, I never hold these more than a couple days, but if I would have held it, I could have made like my standard play. I probably would have been out somewhere in this range. That would have been a solid I would have been like, I don't know, somewhere between $500 and $700 approximately. Yeah. I can't remember why I segued into that. Oh, because I was saying I messed up on that entry. But yeah, it gives you a bit more confidence in, as you can see, if that's possible when you are trading something you do have confidence in, it's really possible when you're trading individual names, at least for me. But I guess in summation, I want to make sure I got through some of those other... Oh yeah, there were a few pictures here I wanted to go through. So back to the leverage ETFs. This is mathematically what I was trying to talk about in one of the other ones, and I couldn't articulate it properly. So due to drag or volatility decay, you'll see here that if you have the S&P 500 index, let's say it's trading at 3,000, it goes down 10%, 2,700. Triple leveraged fund, which you're trading, and its parent is the S&P 500. So if it's triple leveraged and this goes down 10%, this goes down 30%. Well, then to get this back to even, so we can see mathematically how this works, this needs to go up 11% to get back to 3,000. It's actually like 11.1 or something like that, but just is round numbers. Just don't worry about it. Don't worry about it. But this, when this goes up 11%, this goes up 33%, but you're still down on the position, even though over here you're up, or you're not up, you're even. So you're still down on the position because it's leveraged, and that's the nature of leverage, is that if you gain, let's say you lose 50% and then you gain 50%, well, losing 50%, you're gaining 50% on half of your initial capital. So you're only back to 75% of your initial capital. So, same thing. So here's another one just to show, it's like VOO, which tracks the S&P, SPXL, which is a triple leverage that tracks the S&P. You can see here how it's playing out. Up 5%, which means 3 times leveraged, 15%. 6, 3 times leverage, 18. But then by the end of the week here, when this one's mathematically back to even, you're still down on the leveraged fund because of drag, because of volatility decay, and the fact that these are rebalanced daily and have, due to that rebalancing, even outside of this mathematical representation, these lose a little bit of value in the rebalancing effect because there's so much that goes into keeping them balanced for each day to move properly that they may decay a little value just in the nature of that rebalancing, which is no one's fault. It's just the way it works. Yeah, so I think that is all I got on that. I will sum up by saying, what a day we had today. Jesus Christ. The market's going down like crazy the last while, and then really tanks yesterday. I didn't make any trades today anyways, and we make this straight down and then straight back up. That's nuts. And the market's going down on news that Russia might invade Ukraine, and then today they do invade and do some sort of military exercise, and then it goes right back up. But I think the sentiment is that due to Russia invading, the Fed may be a bit lighter on their approach. something like that. I don't really know. Who knows? All I know is it's absolutely insane. And I probably won't trade tomorrow either. I just want to see how this plays out for a couple days and relax. And that's all I got. That's all I got for this one.